Most people think that the way you get rich is by buying real estate. You've probably heard the phrase, more millionaires are made in real estate than anything else. But that's not true. You don't get rich by buying real estate. And in this video, I'm going to show you the real reasons why rich people buy real estate and why you can use the same strategies that they do. Growing up, I had no idea what real estate investing was. I had no real estate investors in my family. I was never exposed to real estate investing. But then I read this little book called Rich Dad, Poor Dad by Robert Kiyosaki. And in that book, he talked about this thing called real estate investing. And that's when I realized that, oh, I could go out and buy a property, rent it out, and somebody else can then live in or use my property, and then they pay me rent. Sign me up for that. Then I read book after book on real estate investing, and then I started doing it myself. Now, I was very fortunate that I started investing in real estate at the bottom of the 2008 crash, so I was very lucky with timing. So real estate was at rock bottom prices, but what I learned very quickly is that it's very difficult for 99% of America to become rich by buying and investing in real estate. Real estate investing is when you buy a property for the purposes of generating cash flow by renting out this property. So if I wanted to go out and buy this $500,000 property, and we can make it a single family home, an apartment complex, it does not matter. Well, there's a couple ways that I can do that. Number one is I can go out with $500,000 in my bank account and then go out and buy this property. Now, when I invest in real estate, I am looking for a 7% cash on cash return on my money, meaning that for every dollar that I invest, I want 7 cents of cash flow profit hitting my bank account every year. So if I have $500,000 in my bank account, I go out and buy this property and I want the 7% return. That means that I'm going to get $35,000 a year of cash flow from this property, assuming I bought it all cash. It's going to be very difficult for me to get rich with this $35,000 a year of cash flow, and I need $500,000 to get started. And most people don't have $500,000 to get started. So what do? Well, you're going to put down a down payment and finance the rest. If I put down 20%, which in this case would be $100,000, that means I'm going to finance the other $400,000. That also means that I'm not going to get all $35,000 in my pocket because I got to pay the bank. Now, for the purposes of this example, if I'm putting down $100,000 and I can get the same 7% yield on my $100,000, that means now my return is going to drop to $7,000 a year from profit. Again, it's going to be very hard for me to get rich with $7,000 a year of cash flow, and I still need $100,000 to get started. This is where everybody says, but Jaspreet, you could just sell this property for a big profit. What if you can sell this property for $1 million? Well, now you can make a lot of money. Sure, but that assumes that you can sell this property for $1 million. How many years is it going to take for this property to appreciate in value? And what happens if you see a slowdown in real estate prices? Because real estate prices don't always go up. Now remember, I'm talking about real estate investing. I'm not talking about real estate flipping or real estate developing. Real estate flipping is now where I come in and I buy this property. I'm going to add in some renovations. I'm going to put money into the property to make it even nicer. That way I can sell it for $700,000. That's not investing. That's flipping. It's like trading. I'm not a flipper. I'm an investor. Real estate developing is now where I'm going to buy the land and I'm going to build a property on top of it. That way I can sell it for a big profit. Or I'm going to come and buy this property, demolish it, and build something else on top of it. That is not real estate investing. That's real estate developing. Both developing and flipping can be great ways to make money, but they're not real estate investing. Real estate investing is when you buy a property for the purposes of generating cash flow, and it is pretty much impossible for 99% of people to get rich by investing in real estate. And the reason why I say 99% of people is because there's always that one person. Real estate investing is something that you do when you have money, that way you can start generating the cash flow. That way you can start getting the tax breaks, and that way then you can actually save your money into a hard asset. When you try to go and get rich by investing in real estate, without talking about flipping, without talking about developing, now you have to start with nothing. And if you have nothing to go out and buy a property, that means now you have to make much riskier decisions. That means now you're going to have to go in and you're going to have to do a lot higher leverage. Maybe you're doing 100% finance deals. And again, this will work for a small percentage of people, but for the vast majority of people, that means way more risk and way more chances of you being foreclosed on. And I'm telling you from personal experience because I have come in and bought multiple deals from banks and from lenders who foreclosed upon buyers and investors who bought properties with little to nothing down on the hopes of getting rich by investing in real estate. And now what happens? They're over leveraged. They don't know how to manage the properties. They don't know how to manage the deals. They don't know how to manage the finances. And then they got so over levered, they couldn't keep making their expenses. The bank took the property back and then they sell it at a discount to somebody else. And in this case, me. Real estate investing is a great way for you to invest your money, period. But you have to know how to invest your money in the right way, and you have to know what type of returns to expect on your money. There are three main reasons why rich people invest their money in real estate. And when I say invest their money in real estate, I'm not saying they buy a big home to live in themselves. I'm saying they go out and invest in rental properties. They invest in cash flow producing real estate. And number one is because of the tax breaks. This right here is the federal income tax code. This is over 2,000 pages long. And what it says is this is what income is, these are what your deductions are, these are what your write-offs are. And I can tell you I have this because I went through law school. And what I can tell you as an attorney, who's not your attorney, is that real estate has some of the biggest and most powerful tax deductions and write-offs that our tax code has to offer. By the way, this book is over 2,000 pages long. Number one is because of the deductions you get, aka write-offs. Now, before you go and implement any of the things that I talk about, talk to an accountant in your area. This is not financial advice. You have to talk to an accountant because all these things are very heavily regulated. So you want to make sure that whatever you're doing is legal. You don't want to run into red flags or run into issues with the IRS. Number one, with deductions, when you invest in real estate, you are essentially starting a business, and your business is investing in real estate, and businesses get to write off some of their business expenses. What can some of these business expenses include? Well, if you're investing in real estate, you need a car to get to and from work. You can potentially write off a piece of your car, or the car value, or your lease, or your car payment. You need gas. You can write off some of your gas. You need a cell phone to operate your business. You can write off some of your cell phone. You might need meals. You can write off some of these meals. So there are many write-offs that you can use, deductions, because now you are investing in real estate, which lower your taxable income. See, for most people, when you're a W-2, when you're an employee, the way that your income statement looks is you make money, then you pay taxes, and then after you pay taxes, that's when you pay for your expenses. But when you own a business or if you own real estate investments, now it's kind of flipped. Now what you do is you make money, and then you pay for your expenses. Now, of course, you can't write off things that aren't related to your business, but you have to be smart here, and your accountant's going to work with you to see how you can write off the most things possible legally. That way now you can file more expenses legally. No, you pay these expenses and then you pay taxes on whatever's left. That means now you have a lower taxable income. If you have a lower taxable income, that's a lower tax bracket, meaning lower tax rates. Not only are you paying less dollars in taxes, but you're also paying a lower tax rate because now your expenses are here instead of here. Then after your deductions, you also get the value of depreciation, which means you get to tell the IRS, hey, my property is a year older. It has wear and tear, and because of that, I deserve a tax write-off on my taxes. Even if your property is more valuable, even if you have no real physical wear and tear, you still get to write off this depreciation against your taxes, which means you get more money in your pocket while paying less money in taxes. Let me show you. Going back to this example that I gave you earlier, where I bought this property for $500,000, and assuming that I buy it all cash, I'm going to get $35,000 worth of profit. This is the cash in my bank account at the end of the year. Well, in residential real estate, so this is homes, single-family homes or duplexes, in this type of residential real estate, you get a 27.5-year straight-line depreciation. I'll explain what that means. That's what it is at the time of me recording, and for commercial buildings, it's 39-year straight-line depreciation. What that means now is you can take the value of the property, divide it by 27.5 years, and that's how much you can deduct from your income, from your profit every year over that 27.5 years, just because your property is older. So how do you do that? Well, let's assume now for this $500,000 property, $100,000 is the value of the land and $400,000 is the value of the building. You can't depreciate the value of the land, but you can depreciate the value of the building. So now you take this $400,000 and you're going to divide it by 27.5, which equals about $14,500. This is how much you can write off from your taxes every year just because your property is 1 year older. So now I go to the IRS, I say, okay, I'm at $35,000, and we'll assume that I have no deductions for the purposes of this example. And now we get to subtract $14,500 $14,500 from my taxes. Remember, I still have 35 grand in my bank account. But on my taxes, I'm gonna write off this $14,500, which means my taxable income is $20,500. Now again, I have $35,000 in my bank account to spend, but I'm gonna tell the IRS I'm only gonna pay taxes on this $20,500, which means not only do I have to pay less money in taxes, but again, lower tax bracket because I have less income. But this is where things get really fun, because what happens if I didn't buy this property all cash? What if I use debt, like I talked about earlier? Now, in this example, I'm only going to pay taxes on my $20,500, even though I made $35,000 of profit. But if I bought this property with a mortgage, now remember, I only had a $7,000 profit. So $7,000 worth of profit, but then I get to deduct this $14,500. So now I subtract this $14,500 and I have this negative $7,500 loss. I tell the IRS, hey, I lost money. I have this $7,500 loss, even though I have the 7 grand in my pocket. I made $7,000 on a financial cash basis. But in terms of taxes, I showed the IRS that I lost $7,500. Now, what you could potentially do if you qualify with your income, this is not for everybody, but some people are then going to be able to take this loss and deduct it against their own income. Now, at the time of me recording this video, in order for you to be able to deduct this loss against your ordinary income, your income from your job, you have to be making under $100,000 a year. And after $100,000 a year, this deduction gets faded out up until $150,000 a year. And the maximum that you can deduct is $25,000 in 1 year. And you also have to prove that you're actively involved in real estate. You have to show that you are some sort of real estate professional with your real estate investment. So again, this is why you want to make sure you have a good accountant on your side to do this. But there are ways for you to deduct some of this income against your ordinary income, the money you make from your job. Now, this is where things get even more interesting, because what if now you make more money, you don't have a job? What can you do then? Well, you can also carry forward this loss into future years. So now if you make a profit in a future year, well, now you can say, well, in the previous year, I had this big loss, and you can keep carrying forward this loss. You're making money, but you don't have to pay any taxes. And the third big tax break that you get is something called the 1031 exchange, which says that you can sell your real estate for a profit and not have to pay any money in taxes if you take your profits and buy another property. So let's jump back to this previous example. You buy this home for $500,000. Now let's assume you own this property for a number of years. It's paying you cash flow, but then you're able to sell this property for $1 million. Pretty good. You made $500,000 of profit. Now you're also going to have to pay taxes on this $500,000 worth of profit, right? Well, maybe. Normally you would, but with real estate, you get this 1031 exchange, which says, okay, you have this $500,000 worth of profit, which would be taxable, but if you take this $1 million and you invest all of it into a bigger property, well, now you don't have to pay any money in taxes today. And now you can keep flipping this real estate year after year after year. You have to hold the property for just longer than a year, so you can't do this in 6 months. This is why you have to be an actual real estate investor. And then you have to buy bigger properties. Now, if you do this until you die, you never have to pay any taxes on this. But if you keep doing this 1031 exchange, you don't have to pay any taxes on the profits of this property. Now, again, this is very tricky. There are many regulations on this, so make sure you have a good real estate accountant and a good real estate attorney that will help you do this. So don't just go and blindly do this and expect not to pay any money in taxes, because if you just do this and you do it wrong, not only are you going to pay taxes, you're also going to pay penalties and fines. So make sure you have a good team, a good real estate accountant, and a good real estate attorney. Now this brings me to the second reason why people love investing their money in real estate, which has to do with saving hard money. Now, of course, if you are a real estate investor and you want to stay up to date on what's happening in terms of the real estate market and the stock market and crypto and our economy and the global economy, then if you haven't already, join Market Briefs. Market Briefs is a completely free resource that I created to help you stay up to date on what's happening in the financial markets. It's a daily financial newsletter that breaks down what's happening in all the financial markets into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning. It's super easy to read. So even if you don't have a financial background, not only are you going to understand what's happening, but you're going to look forward to reading Market Briefs every morning. And the best part is it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. The second benefit that you get for investing in real estate is you are investing your money into a hard asset. A hard asset is a real physical asset as opposed to saving your money cash, because cash is just pieces of paper, and potentially saving your money in the stock market because the stock market is also liquid and a paper asset, which means that you really don't own anything physical, anything tangible. When you own real estate, the actual property, not only do you own the land, you own the building, you own the bricks, you own the windows, you own the doors, you own the fixtures, you own the carpets. You own something physical, something that you can see, feel, and touch. Now, there's a couple benefits to this. The first benefit is diversifying your savings away from cash, because if you look at historically, our cash has been losing value for decades now because of inflation. Now, sure, in the short term, you can see swings up and down with the dollar, but over the long term, our dollar is losing value because we keep printing more money. And as you print more money without producing more wealth, the value of the dollar drops. So this inherently makes real estate more valuable over time because, well, the value of the dollars that buy the real estate are going down in value, which makes real estate more expensive, even if it's not necessarily more valuable, because the currency that you're using to buy the real estate is dropping in value. Now, of course, you're going to have short-term swings up and down in this, but over the long term, that's what inflation is. And so when you buy real estate, the second reason why especially rich people like the idea of owning real estate is because most banks are only FDIC insured up to $250,000 per person, which means if you have millions of dollars sitting in a bank and that bank were to go under, well, now that cash that you have sitting in the bank is also at risk. So if you invest your money in real estate, well, now you're a little bit more protected. Now the risk is, what happens to real estate if something happens and it burns down? Well, you have real estate insurance. And so you have protections against your real estate that you don't necessarily have if you keep all of your cash in the bank. Now, of course, real estate has risks too, because the value of real estate can drop. When the 2008 real estate crash happened, real estate prices in Michigan fell by more than 90%. You had some properties fallen by 92%. And so you do have your own risks with real estate, but there is a benefit to owning real estate because you also own this hard asset. And the nice thing with real estate, what we've seen throughout time, is that if you own good real estate, really any good investment, and you hold on to it through the bad times, then you should be able to recover your losses. Now, of course, investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you should always do your own due diligence and never blindly listen to a random guy on YouTube, but understanding that real estate has some risks, but the benefit as a hard asset is you own something that you can see, feel, and touch. Now, of course, you don't need $250,000 to go out and start investing in real estate. You can start investing in real estate with significantly less, but what I'm trying to say is if you have excess cash, now you can start generating a return from this cash. Real estate is not going to make you rich because you need a lot of cash to get started, and you might only make a 5 to 10% return on this cash. So it's very hard for regular people to get rich by investing their money in real estate unless you become more of a flipper, or you can sell these properties for a big profit, or you become much more actively involved in real estate. But real estate over the long term has proven to be a great place to save money. It's proven to be a great tax haven, and third, it's a great way to generate cash flow. Now, I've kind of been touching about this the entire video, but the reason why I invest my money in real estate is because it creates a cash flow stream. And if you do it correctly, this cash flow can be generally passive. Because now if you go out and buy a property, and we'll make it a little bit smaller. We'll call it a $100,000 property. And I know some of you are thinking, but Jaspreet, where in the world am I going to find a $100,000 property? They do exist. You look in the Midwest, you will find properties for under $150,000 in good areas. Now, if you go out and buy this $100,000 property, well, my goal would be to get a 7% cash on cash return on my money. Meaning, if I bought this property cash with no debt, that means I want to get $7,000 worth of profit cash flow every single year. Now, the return and the risk is I have to put in $100,000 of my own cash to buy this property. You don't have to put in all cash. You can finance the deal. You can find investors. You can do creative financing. There are a lot of ways to get the cash to finance the deal. But to keep it simple, I'm going to assume that I bought this property all cash. I had $100,000. I go out and buy this property. And in that case, it's going to generate $7,000 worth of profit. This is the type of return that I'm looking for when I invest my money in real estate. Now, for me, I want this cash flow to be as passive as possible. And in the beginning, the reality is real estate is going to be anything but passive because you're going to have to find the right team. Who is a good property manager? A property manager is somebody that you hire whose sole job is to manage your property. They're going to find a tenant. They're going to handle the repairs. So if the toilet breaks in the middle of the night, they call your property manager. They don't call you. You got to have a good attorney. You got to have a good accountant. You got to have a good real estate broker. You got to have a good real estate inspector to walk through the deal before you actually buy the property. And you have to make sure that all these people are working together. Now, this is going to seem super overwhelming in the beginning because when you get started, there are so many things that you don't know. And the more you learn, the more you realize you don't know. But once you get started, you'll see that one person will help you find the next person, and the next person will help you find the next person. It is a process, and it's a part of the game. You have to go through this initial learning hurdle, which is very difficult. It's time consuming, but once you do that, then real estate investing can be much more passive. Now I have a full team. When I go out and invest in a property, I meet my property manager there, I meet my contractors there, I meet my broker there. We go through the property to see what needs to be done, and then my property inspector will also tell me, this is what's good about the property, this is what's not so good about the property. Now I can see if it's a good property that I want to invest in or not, and if I do want to invest in it, my contractor will give me a quote on how much it's going to cost to renovate the property. If I like this, I'll show it to my property manager, they'll tell me what I can rent it out for, and then I just hand it off to them. My property manager knows exactly what needs to be done, and then every month I get a report, and every quarter I get a report from all of my properties. That way I can see what the profits, what my losses are. This sounds very nice, but it took a lot of pain, a lot of time, a lot of hardship, and a lot of mistakes to get there. Now I can talk about the different things that you need to do, and I have lots of videos on my channel where I talk about that, but you can't bypass the mistakes. You can't bypass the experience. It's a part of real estate investing. No matter how many real estate books that you read, no matter how many real estate videos that you watch, you can watch my videos where I go through my worst real estate deal ever. I'll link that for you down in the description as well. But you're going to learn a lot from that. Things that you won't read in books. But no matter how much you learn, I can guarantee, this is one of the few things that I can actually guarantee on this channel, you're going to run into new problems that you never heard of anybody else dealing with, and it's going to teach you a new lesson. That's what real estate investing is, that's what business is, that's what entrepreneurship is, but that's a part of the process. And you're also going to learn how to build the right team, and if you can build the right team, then this cash flow can be much more passive. Now, is it completely passive? No, you still got to review the reports. You still got to review your property management company, and you still got to make sure that your team is working good. But once you know how to do it, it becomes significantly easier because now you have all the processes in place to systemize your investment in real estate. And now your goal is, how can I increase my cash flow? How can I buy one property a year that way I can just keep upping my cash flow? You just stack in that cash flow, $7,000 a year from this one, then the next one, another $7,000 a year, then the next one, another $7,000 a year. And now in a few years, now you start stacking that cash flow, and now you have some significant cash flow coming in from your real estate. It sounds difficult, and it is, but you have to get started. The first deal is always the hardest. Once you figure out how to acquire the deal, once you figure out how to find a good location, once you figure out how to finance the deal, once you figure out how to do it, well, now it's just about rinsing and repeating and improving the process again and again and again. There are 5 keys to being a successful real estate investor. Number 1, you need to know how to find a good location. Number 2, you need to know how to build a good team. Number 3, you need to know how to run the numbers. Number 4, you need to know how to do the due diligence on the property. And number 5, you need to know how to increase the value of your investment. These are things that I learned over the last 12 years of investing in real estate, making a lot of expensive mistakes and seeing some success. So let me start by talking about number 1, which is understanding the location. The 4 factors that you want to be paying attention to when you're looking at a good location is the crime in the area, the population and population growth, businesses moving in or out, and the walkability of the area, especially if you're looking at a city, a more urban environment where people can actually walk around places as opposed to a suburban environment where people have to drive places. So let me start by talking about crime. I mean, the general consensus is people want to be in a safe place. And so you can go do a Google search to see the crime in your neighborhood, see the crime in the city, see the crime in the county, and see the crime in the general area. And if you see crime increasing, that's a bad sign. If you see crime decreasing, that's generally a good sign because tenants want to feel that they're safe in your home. But you want to take this factor with a grain of salt because Manhattan has a lot of crime, but people want to live in Manhattan. California has crime. People want to live in California. Just because it's crime doesn't mean it's not a good place to invest. It's something that you want to be paying attention to if crime is rising or if crime is going down. And you're not always going to get a good answer by just searching crime scores and looking at crime maps on the internet. This is where you got to get the feel of a neighborhood where you're investing because real estate is very localized. And you don't want to just throw your money into an area because you think of something good that you found on Google. You want to actually drive the neighborhood, walk the neighborhood, stay there for a little while, and get the feel. You're not going to be able to get that real feel of the area without actually spending some time there. And if you want to actually be a real estate investor, you need to spend time in the areas that you are investing. If you don't live there, fine, drive through it, walk through it. Do you feel safe walking through it? And is it somewhere where you wouldn't mind spending some time? Second, on the population side, do a quick Google search of the city and neighborhood that you're looking to invest in and see the population. So go to Google, search Manhattan population. And what this will show you is the population and the population trend for Manhattan. And you can do this for different neighborhoods, different cities around the country. And what you want to see, ideally, is populations rising or at least populations staying stable. But you don't want to see populations dropping, because if populations are dropping, that means that the amount of tenants in that area are probably also dropping. And you want to be investing in an area where more people are moving to, because if there's more demand for your property in the future than there is now, that means that rent prices will probably have to go up because more people want to live in the area that you own that real estate. Third, you want to be investing where businesses are moving to. So this is a little while ago now, but I remember I was looking at some real estate in a city that's near me, and there was a city block that was completely vacant, and it had some big real estate that was all vacant, and it didn't look good. And I asked the city about what was happening here, and what they said is that a Walmart had just entered into contract to purchase all this land, to purchase the building, and they were planning on opening a Walmart supercenter. When I heard that, I started buying up some of the real estate near this area, and over the next few years, not only did Walmart open up a supercenter here, but then you had all these other new retail stores that opened up around the Walmart, because Walmart brings a lot of traffic. People want to go to Walmart. And so that opened up all these other new retail shops, and then new real estate developments opened up on the other side of the street, which was also vacant, and this drove a whole new set of traffic and businesses into this area, which meant more people wanted to be here, more people wanted to shop here, and more people wanted to live here, which not only increases the value of the real estate, but it also increases the rental prices of the real estate. Now, how do you find where businesses are moving to? Now, you can look at the press, you can look at the news, but many times if it's already hitting the news, it might be a little bit too late. And this is where real estate is special, because this type of insider trading, insider investing is not illegal in real estate. In fact, it's completely legal. So how do you get this information? Well, one of the best places to go is actually the city hall. Just go to the city hall, the building department, and ask them if there are new businesses coming into a particular area. Is there some new developments coming? What's new happening in this city, in this neighborhood? And they'll tell you. And if you hear something interesting, that a big business is coming, that Amazon is opening a new Whole Foods, that Best Buy is doing something, that something is happening. I don't know why I said Best Buy, but something is happening here that's going to be driving new demand, that's going to be driving new businesses. That can create opportunity for you, because now you can capitalize on the increase in real estate value in the area by owning some of the real estate. And then when rent prices go up, well, now you get to reap some of the rewards of that. And finally, you have walkability. So if you're investing in cities, walkability is extremely important, because people want to be places where they have easy access to buses, easy access to subways, easy access to public transit, and easy access to food and groceries and everything around them. So walkability is extremely important when you're investing in those types of city and urban areas. But this is where you got to understand what type of investor do you want to be, because you also have some investors that hate the idea of investing in big cities. I know some investors that I work with that do the complete opposite. They invest in more rural type areas, and what they say is that one, there's much less demand, they're not competing against other investors, and second, the tenants that live there stay longer because they just live in these rural areas for much longer and people don't really move. So it's a completely different game, completely different demographic, but it creates opportunity for, depending on what type of investor you want to be, it creates opportunity for you if you know what the goals are. If your goal is to be investing in the rural type areas, you really got to know the neighborhood. You really got to know the people, and you're not going to have the same type of demand as you would in this heart of Manhattan. And so you got to understand where do you want to be, and the returns that you're going to get are also going to be different. You have smaller returns in Manhattan, generally, if you're looking at a cash-on-cash investment, because, well, it's much more expensive to buy in Manhattan than in a village somewhere. But in that village, you're not going to have thousands of tenants and thousands of people that are willing to make applications to live in your place. So you're going to have higher vacancies, and you're going to have higher wait times. And if you have a turnover, that can be more costly. So you have to understand where it is that you want to be, or somewhere in the middle as a suburban investor. So there's many different types of investing, and each one is going to have their own goals and have their own interests, and tenants are going to want different things. If you're investing in cities, that's great. but you got to understand that what people want is walkability, and something that will help you understand this is going to walkscore.com, and you can see what the walkability is for a particular address and a particular neighborhood, that we can see if that's somewhere where people would like to live. The last thing that I want to mention on location and walkability is you can also consider investing where walkability will be increasing. Like in Detroit, there was a new rail that was put in, and many investors started buying up land around where this new rail was going to go to start investing in this new walkability, because this new rail was going to create a new line of public transit, and that would open up more opportunity for people to go from one place to the other. And so people started buying up the real estate all around it in anticipation for the new rail. But you just got to make sure that it happens, because if that new rail isn't as good as what people would expect, then you might be buying up this real estate and then find out that it's not as valuable as you would like. So you got to be careful with that type of speculation, because there are risks involved with it, but it can create opportunity if you see the walkability increase. The reason why location is first is because you can change everything about a property except its location, which is why location is so important. Now this brings me to number 2, which is understanding your team. And I'm going to be highlighting 8 different team members that you need to have if you're going to be investing in real estate. This is your property manager, your real estate broker, your accountant, your contractor, your attorney, your banker, your title company, and your insurance company. Let me start by talking about your property manager, because either your property manager is going to make your life completely miserable, or they're going to make your life very free and clear. I have worked with a lot of property managers. Some of them are great, some of them are very, very bad. And the bad ones will make your life literally a nightmare. My first property manager that I ever had, I don't even know if they were a real licensed property manager or not, but my tenant had my phone number, and so my property manager did nothing. They were collecting the rent, they were collecting their fees, but my tenants would call me anytime something went wrong. Now, the whole purpose of a property manager is to make real estate passive for you. When you buy the property, you're supposed to give them the keys, and then they're going to manage everything. They're going to find the tenant, they're going to make sure the tenant pays, they're going to make sure the bills are paid, they're going to handle all disputes with the city, with the tenant, and everything in between, and then they're going to take a small fee. This fee might be somewhere between 4% to 10 or 11% of your gross rental income, depending on how many units you have, depending on how much work that they're going to do. Now, this is a cost to you, but it also saves you a whole bunch of time, because now the real estate whole investing process can be completely passive on your end, and your job is to be a real estate investor, not a real estate manager, which is why I never manage my own properties. But my first property manager was a property manager who was supposed to make it passive for me, but it was anything but passive. So I was getting calls from my tenant, I was dealing with all the issues, and eventually I fired this property manager, then I got another property manager. Now the second property manager was a lot better. They documented everything. I had a lawsuit happen in one of my real estate properties where a tenant sued my real estate company because they said that the bathtub got too slippery when the water was on, and it caused them to slip and fall because the bathtub was too slippery. Well, anyways, that case got thrown out because ultimately they figured it out that the tenant didn't slip in the bathtub. The tenant ended up slipping at a barbecue. They were just trying to go after some money, and they did get some money, but the tenants actually didn't get any money because my insurance company settled with them, and they didn't make enough money to even pay the attorney fees, so the tenants ended up getting nothing. But that's real estate, and that's the way the world works, especially here in America. We are the most litigious country in the world, so you have to be prepared for these types of things. Well, having a good property manager can definitely help with that, because one of the things a property manager is supposed to do is document everything. Every time your tenant has any sort of communication with the property manager or with the contractor, this needs to be documented. And if you are the one that's documenting everything, well, it's going to be a huge pain in the asset. This is why I don't recommend you doing that. This is where you want to have a good property manager to do that. Well, that same property manager company had some changes internally, and then they started not really managing properties. I had a property, and this is here in Michigan, where it gets cold. I had a property that didn't get winterized, because when it gets cold in the northern states, you have to winterize properties. That way pipes don't burst when tenants are not there and when the heat is not on. Well, this property was not winterized, and then a pipe burst because, well, nobody was there, and for some reason the heat didn't work. And now the pipe burst and the whole property got destroyed, and nobody knew about it. This property just kept flooding and flooding and flooding. And then eventually somebody from the property management team went out there to go show the property to get it leased out, and then they see that this property is completely flooded, and this created a huge mess. Well, that property management company then had to pay me a lot of money, and then I fired them. So this is where you have to make sure that you have a good property manager. Now, how do you find a good property manager? Well, you have to ask them a lot of questions. One, how are they getting paid? Some people say that it's very bad to pay a property manager a flat fee because now they're getting paid even if a property is vacant. I've had different experiences where it's not that big of a deal if a property manager charges you a flat fee, so long as they do a good job. I don't like when property managers are going to charge you a fee to then do any sort of construction work. What that means is a property manager is going to do all the repairs, or they're going to go find a contractor to do the repairs. You're going to have to pay for the repairs. That's the way it works. But then if the property manager is charging you a fee to then manage and issue the repairs, that I don't like. Because many times what I've seen happen in the past, with myself as well, is when a property manager is charging you a 10% fee on top of whatever the repair is, they're not going to have the best incentive to go out and get you multiple bids to find you the lowest price possible to do a renovation, to fix a deal, because the more that you have to pay, the more the property manager makes. So I don't like that. Second, when it comes to the way that they handle tenants, you need to understand what are their policies when it comes to issuing the eviction notices? What are their policies when it comes to being lenient on tenants? Because you want to make sure that whatever their policies are aligned with you, and you need to make sure how you get paid. When there's a late fee, who gets that money? Is it the property manager or is it you? I don't think it should be the property manager. I think it should be you. Maybe the property manager takes a little bit if they're going to be issuing notices for the late fee or because the tenant's late. But that's money that you should be receiving, not your property manager. So you want to be asking these questions and understand what their protocols are and know where you can find all the information about your properties, about your leases, and about your P&Ls, your profits and losses. That needs to be figured out early on. So ask these questions to your property manager. Second, when it comes to your broker, the biggest mistake that I see real estate investors making is they try to find a real estate agent who's well known, a good real estate agent, and then they want them to represent them to find them real estate deals. Well, a regular real estate agent is helping people buy and sell the home that they live in. They're not helping real estate investors find a real estate investment deal, because a real estate investment deal is very different than the home that you're going to be living in. And that real estate agent who's going to be sending you deals is going to show you deals that somebody would want to live in, but not something that you want to invest in. And these are completely different deals, because a cute home is going to give you cute profits. And you got to decide, do you want the cute profits or do you want the big profits? And it's going to be a completely different way of the way that you look at deals, the different way that you look at properties, different locations, different types of properties, because somebody who wants to live in a home might not want to buy a beat up property. But that beat up property can make you much bigger returns if you come in and renovate it, because you'll be able to buy that property for a huge discount, and then you can fix it up and then rent it for a better price, because now you have a fully renovated property and you got it at a discount. So you want to make sure you have a broker that specializes in real estate investment deals. And even if you are a real estate licensed salesperson like I am, I'm a licensed salesperson. I got licensed when I was 20. I used to work with people who wanted to buy and sell homes. I worked with investors. I work with a bunch of people, but I don't broker my own deals. I have another broker that I work with. I go look at the properties. I'm licensed, so I can go and do that. But then when I want to do up the paperwork and do all that stuff, I call up my broker and I have them fill out the paperwork, and then they send it to me, and then I sign it and send it back to them. That way my work is less. I want it to be as passive as possible for me, so I have a broker that I work with that does all of my contracts, and that way now he takes a piece of his commission. I still get a little bit of commission, and I just put that into the deal because I am a broker. But this is where understanding what are your goals. Do you want to be doing all the work to find the research, to find the properties, or can you hire somebody to do that? And that's where a good broker can help. Then you need a good accountant. I cannot tell you how valuable a good accountant is, because I've had a bad accountant and I've had a good accountant. And if all your CPA is doing is filing your taxes, you are leaving a lot of money on the table. And if you are going to be investing in real estate, you absolutely need a good accountant now, because now it's not just showing your W-2. There are so many different deductions, so many different things that you can do in real estate to allow you to make money and pay less money in taxes legally. And your accountant has to understand and specialize in real estate investments, because there is so many different types of deductions, so many different legal loopholes that you can use with real estate that will allow you to pay less money in taxes legally, and you want to bring the accountant on and make them informed from the early stages. As soon as you buy the property, that's when you need the accountant to understand what's going on, because there's so many different things that you can do when it comes from buying the property to doing the depreciation to potentially doing accelerated depreciation to then potentially offsetting some of the income that you make outside of real estate through the real estate that you're buying. So talk to an accountant about the different strategies that you can use, where you use real estate to offset some of your other income and where you use real estate to generate cash flow but pay less money in taxes legally. Fourth, you need a contractor. Again, I've learned this the hard way because I've had good contractors and I've had very bad contractors. And very bad contractors will save you a lot of money right now. But if things go wrong, then not only are you going to have to pay to fix their work, but then you're going to have to pay to do the work right. And I have dealt with this on multiple occasions because in the beginning, when I was getting started, I found the cheapest of the cheap contractors and they did work cheaply, sometimes quickly, sometimes not so quickly. But it's such a pain where you have to stand over them every single day to make sure they're at your property, to make sure they start working. And then when they're not working, you got to call them to see where they are, because then they start another job in the middle of your job. Get a good contractor. It's going to cost you a little bit more, but it's going to save you so much headache. It's going to save you so much time, and it's going to save you money in the long run, because when you have to keep paying to fix up your previous contractor screw-ups, it really starts to add up. And then it makes tenants upset because things keep breaking because your contractor didn't fix it the right way. So now I work with a licensed and insured contractor. And yes, they charge me more money, but it costs me way less headache and my things get done correctly the first time. Pay more to do it right the first time, because if you don't, well, 5 years later, you're going to understand why it's way cheaper to have a good contract to do it right the first time. You all learn. Everybody learns at some point. Then you need a good insurance person, because guess what? As a landlord, you need a good insurance. You need landlord's insurance and you need liability insurance. I talked about the time that I got sued because a tenant claimed that the bathtub was too slippery when the water was on. And, well, I had to go through my insurance, because now you need an attorney, someone who's going to charge $300 to $500 an hour, who is going to sit there and defend you. Now, even though I was right, somebody still had to pay the attorney hours worth of work to go through the whole process to get this case settled and dismissed. And yes, we had to go through a settlement because it was stupid. The judge wouldn't see it. The judge said settle this outside of court, but you still needed an attorney to do that, and then the insurance company had to give the other party some money so they go away. The tenants who were suing me didn't make a penny, but we still had to go through this whole process because that's the way the system works. It's crazy, I know, but this is why you need insurance. So make sure you have landlord's insurance, make sure you have liability insurance, and it doesn't hurt to spend a little bit of extra money to up the insurance, because we live in a very litigious country. Then you need your title insurance. Now, title insurance has been known to be one of the biggest wastes of money when it comes to insurance. Well, it is a waste of money that you hope becomes wasted, because guess what? I've also dealt with title insurance issues. This is what happens when you go through a lot of real estate deals. Title insurance is something that protects what you buy. So if you buy a property, you think you're buying a home, what title insurance says is that you're actually buying the home that you think you're buying. In case somebody from 10 years before comes and says, no, I own this property. You bought it from somebody who didn't actually own it. Title insurance is there to protect you against those types of situations. They are very, very, very rare. But when they happen, that's when title insurance can be valuable. Now, title insurance is something you get typically when you just close on the property, but you want to make sure that you have title insurance, because there's sometimes when you go through auctions, you go through foreclosures, that you don't get this type of title insurance, but you want to make sure that you get this because it can save you a huge headache. I bought an apartment complex on a lake. And this apartment complex was made up of 4 different parcels of land. It was a beautiful area, beautiful complex. It was run down, but I was coming in to renovate it and turn it around, and I did. And a few years after I purchased this property, we fully turned the property around. We put in a ton of money into this property, and now it's fully rented, because when I bought it, it was completely vacant. Now this property is doing great, and it's producing a lot of positive cash flow. And then I get a letter from my attorney saying that apparently somebody else now owns a piece of my land. And I said, what are you talking about? So somebody had a claim on this land, and they had owned this claim to somebody else, a previous owner. And this never trickled down to me. and the title company never discovered this. So whoever owned this property and had this loan on the property wasn't making payments because they no longer owned the property, and then the bank, the lender that was owed money from the property, wasn't receiving money. So then they started issuing foreclosure notices. And where did they put these foreclosure notices? Somewhere on the property where nobody was going to see it. And so they put it on the property, and they knew that nobody was going to see it because apparently that's the way the game works, because they wanted to get the property, they didn't want the money, and this went on and on and on, and then eventually they put up enough notices, and then they got the right to the property. So now we get a letter saying, hey, you no longer own this piece of the property that cuts through some of the units, that cuts through some of the land, and now they say that we own this and that we have to pay them for it. So what did I do? Well, I told my attorney talked to my title company, and then my title company had to then settle with that previous owner. Yes, it is very rare, but you don't want to have to deal with the headache if it does happen. Then you need a good banker. If you are financing your properties, you want to make sure you have a good banker that is going to be there to then help you get approved, to help you get the financing, and then who's not going to screw you over later on when things start to go wrong, because the reality is the economy goes through ups and downs. And so banking, while it might seem just like a transaction, you need to borrow money from somebody else, it is a very much a relationship thing. So you want to make sure you know the person that you're working with, that they know you, they know your business model, they know your goals. So keep that relationship with your banker, because they're going to be able to save you a whole bunch of headache later on. And just like anything else, you gotta make sure you have a good attorney. Look, I am a licensed attorney, and I don't do any of my own legal work. I have a number of different real estate attorneys that I work with, people who specialize in different things, and you wanna make sure you have an attorney from the early stages of the deal. Even if you're buying a single family home or a condo, get an attorney early on board so they know what you're doing, so they can give you advice. That way maybe it's creating an LLC. That way they can make sure you don't miss the insurance part. That way you know you have all the things in place before you buy the property, that way you're protected legally, and that way your contracts are reviewed. And sometimes you might say, but it's just a standard contract. Yeah, well, sometimes it's not. And you want to make sure that nothing is sneaking through the contract that shouldn't be, that they make sure that your title insurance is what it should be, that they make sure that your closing is giving you exactly what you should be getting. So make sure you have a good attorney. If you need a good attorney, I have a referral service where I can refer people to a good attorney. If you want to learn more about that, I got the link to how you can find a good attorney, not just real estate attorney, bankruptcy, a business attorney, whatever kind of attorney. If you're looking for a good attorney, I'll put the link to how you can be referred to a good attorney down in the description below. The third thing that you have to do is run the numbers to make sure the deal makes sense financially, and you're going to always start with this even if you're getting debt to buy the property. So you start with what you think the rent is going to be, then you subtract the property taxes, and if you're going to be buying this property, you have to calculate if property taxes are going to be going up, because if you're buying a single family home where somebody lived and now you're going to be renting it out, well, your taxes are going to go up, because most cities charge higher taxes to landlords than to homeowners. And if the property value, the assessed value, is going to be going up, well, your property taxes are also going to be going up. So you can talk to the assessor in the city, and they'll give you a better idea of what your property taxes will be after you buy that. So just talk to the assessor, see what the property taxes will be. Then talk to a couple insurance agents to get an idea of what your insurance will be. You need insurance. You subtract your property taxes, your insurance, your maintenance costs. Now, this maintenance cost is going to be a number that you're going to have to calculate. If the property is older, if it needs more maintenance, you want a bigger number here. If it's newer, well, you don't want to put zero, but something. A fraction of 1 month's worth of rent. So you could put a month's worth of rent or a fraction's worth of rent, depending on how new the property is and how much deferred maintenance is on the property. Then you're going to subtract your management fee. Even if you're managing the property yourself, which I don't recommend, you still want to pay yourself, because you have to make sure that you factor in your time, where if somebody else was going to do it, how much would they charge? So you got to make sure that the numbers make sense, even based off of yourself managing it. So if you are managing yourself, put in a number. If you have somebody else manage it, enter in what their number is, and then enter in a vacancy factor. Even if your property is fully leased out right now, eventually a tenant is going to leave, and you're going to have to then re-tenant that. And when they leave, there's going to be a period of time where nobody is in there, so you want to make sure you enter in a vacancy factor. I like to typically put in 1 month's worth of rent. It depends on the economy. Sometimes it might be 2 months or a month and a half, just depending on where you are in the economic cycle. But enter in a vacancy factor. So now you start with your rent, you remove these expenses. This is your NOI. If this NOI is big enough, well, that's a good deal. If this NOI is negative, that's not a good deal. Now, how do you know if an NOI is big enough? Well, what I like to look at is I take this NOI number, this monthly NOI, multiply it by 12, So now you have an annual NOI number. This is how much profit you expect to make. Again, if you're using debt, we'll talk about that in just a second. But this is how much profit you expect the property to make over the year, and then you divide that by the price of the property, and this will give you something called the cap rate or the return on your property. And if that number is high enough, well, then that's a good deal for you. If it's not high enough, then you want to keep looking. And I'll show you what that means right now. Let's assume for the purposes of this video that you can buy this property right here for $100,000, and this property is going to rent out for, let's just say, $1,100 a month. And you have $500 a month worth of expenses, so you go through the same analysis that I just showed you, which leaves you with $600 a month of projected NOI, projected profit. Now, I'm going to take this $600 of monthly profit, multiply it by 12, which means that I'm going to have $7,200 of annual NOI, net operating income. That's what NOI stands for, or profit. Now, I'm going to take the $7,200 of annual profit, NOI, and I'm going to divide it by $100,000, which is the total price of the property, which gives me a 7.2% return. For me, that is a good deal. I look for anything more than 7% here as the initial rule of thumb when it comes to investing on money. If it's more than 7%, I will consider the deal. If it's under 7%, it's not a good enough return. Now, this return is going to depend from area to area. Some neighborhoods are much higher, some neighborhoods are much lower. You got to decide what is a good rate for where you are. But for me, I know that I want a 7% return. This is where now you have to do your debt analysis. Let me wipe this off and show you what that looks like. If in this case you were to put down 20%, that would be $20,000. So now you put down $20,000, that's your equity, and you're going to be borrowing the other $80,000. And if you borrow the other $80,000, that's a 7.5% interest. That means now your interest rate is going to be costing you $560 a month, which means you have a $40 a month profit now, which $40 a month times 12 is $480. So $480 is your new profit. Now, the way that you're going to calculate your return now is you take your $480 that you're making in profit, and you're going to divide that by your equity, which is $20,000. Here now, it's about a 2.5% return on your money when you factor in debt, which isn't a very good return, because now that you're getting debt, you have a higher risk. Because your higher risk is you have to make payments to your bank, so you want to be compensated for that. So you want a higher return here than you would if you just paid cash, and this is where you got to start with the cash analysis. Then you do the debt analysis, and you want to make sure if everything makes sense. If the location is good, the numbers make sense, the next thing you want to move on to is the due diligence. This is after you enter into a contract to buy the property, where you now review everything to make sure that everything is good. Now, before I go into the due diligence things that you want to work on, if you do want to stay up to date on what is happening in terms of real estate trends and stock trends and crypto trends and the economic trends, then you can join Market Briefs. It's my free newsletter that I created to help investors make better decisions. It's completely free, and it's a simple breakdown that you can read in less than 5 minutes every morning that will help you understand what's happening in the financial markets. That way you can make better decisions with your money. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. As soon as you enter into contract to buy a property, there's going to be 5 people that you want to call. One of them is not listed here. This person is whoever's going to be helping you finance the property. Whether it's a bank, whether it's investors, you want to call them to make sure you can get the cash, but that's not really going to be your due diligence. The due diligence is going to be working with 4 people. One is your property inspector, one is your property contractor, one is your property manager, and 4th is the city. Let me start by talking about the inspector, because as soon as you enter into a contract to buy this property, you want to make sure that this property is what you think it is. And this is where you want to get a private property inspector who's going to be walking through the entire property to give you a report on the health of the property. You have to do this, because I can tell you from experience that if you don't do this, you can run into a ton of mistakes. My worst deal ever was a deal where I trusted my contractor, who was not a property inspector, that I should go out and buy a property. He told me to buy a property because Well, he said that we could flip it for a quick return, and turns out that he really just wanted me to write him a check so we'd have some work to do because he was struggling financially. I ended up buying a property that was so run down that you couldn't see because it was covered up with a whole bunch of problems where the pipes were completely frozen because somebody had poured cement down the pipes, where nothing worked, the HVAC units were shot, everything was just wrong in the property, where it cost me tens of thousands of dollars, way more than what I expected because I did not get a property inspector to walk through the property, to look at the pipes, to look into the basement, to look into the foundation, to look into the attic, to make sure that the property is what you think it is. So do yourself and do me a favor, pay a few $100s and get a good property inspector to walk through the property as soon as you enter into a contract to buy it before you actually close on it. That way you know what you're getting. Second, get a good contractor to walk through the property, because if you're going to be doing renovations, you need to know what it's going to cost you. And the price of things have always been fluctuating. So this is where, as soon as you know what's wrong, you know what you need to make changes on. And if you're going to do renovations, get your contractor to walk through the property so you know an estimate of what it's going to cost you to make the repairs. And if it's way more than what you thought, then you can back out of the deal. But if it's in line with what you thought, well, now you already have your quote, and as soon as you close, you can get the work started. Third, get your property manager to walk through the property. That way they can get an idea of what the property is. They can give you renovation ideas if things need to be upgraded, because they should know the neighborhood, they should know the city, they should know what tenants want in the area, and they'll be able to give you a good idea of what you can get for the property in terms of rent, and then you can make sure that what you can get for the property is in line with what you expect. And fourth, get the city involved, because you want the city to know that you're looking at buying this property, that you want to rent it out, because maybe they're creating some new restrictions on new landlords. You want to know that before you enter buy the property. Maybe they have some outstanding liens. You want to know this before you buy the property. Talk to the city, see what needs to be done in terms of licensing, because if they have their own requirements in terms of licensing, if they have different changes that they want to make, you want to know that beforehand, because if you don't know that, it can end up costing you a fortune after you buy the property with a whole bunch of repairs and upgrades that you didn't know that you have to make. So talk to the city beforehand, before you close on the property, so you know what the total cost will be to turn the property around after you close the property. This is going to be done in the due diligence phase of the property. You always want to have a due diligence phase where you have time to do these types of inspections. If you don't do these inspections, you are taking on a huge risk. And the reason why I'm emphasizing this is because I made this mistake and it ended up biting me in the asset. So please don't make the same mistake that I did and get these inspections before you close on the property. And the fifth thing that you have to understand is, how do you increase the value of your property? And for me, what that means is, how do I increase the cash flow from the property? Because when I invest in real estate, my goal is not to flip the property for a big profit. My goal is to generate cash flow, because I want enough cash flow from my real estate to be able to live my life that will now have this passive cash flow that I can use, and I can live my life without having to worry about the cost, because every month I'm going to get another cash flow check from real estate. So the question is now, how do you invest in your properties to increase the cash flow? And this is going to require research on your end, and this is where a good property manager can help you. Just yesterday, I was talking to a property manager of mine, and we were talking about an apartment complex that I own. And I was asking him what his thoughts are on buying another property and what the different options were and what my goals are, because he knows that I'm looking for a 7% cash on cash return on my deals. And he said, one of the things that we could potentially do is do a $250,000 investment into this particular investment complex. And what he says is that we will be able to increase our NOI by 11%. If I make this $250,000 investment by upgrading the bathrooms, by upgrading the kitchens. Because according to him, he does the research. He's been looking at different properties. He manages different properties in the area. He sees that there's more upside in the area, but we need better units. We need better kitchens. We need better bathrooms. And so if we can make this investment to improve the property, it's going to cost me money today. I can use that $250,000 to go out and buy another property, but it's harder right now to find a good deal. But if I take that same money and invest it into my own property, I can increase my rents, I can increase my NOI, and I can create a better property for my tenants. There's an unlimited number of things that you can do to increase the value of the property, but what you should do is going to depend on your market, and that's going to depend on what people are already willing to pay for. Now, you can be one of the people that's the trendsetter, you can be the person that's creating the new value, but typically that's going to require either a lot of money, because now you're going to be making a brand new development that's creating a brand new type of market in the area, or you're going to have something small and you're going to hope for somebody who wants an exceptional property that no one else is willing to pay for. If you're in the middle, I rather look at what other people are charging and make sure that I'm in line. That way I'm not overcharging people, I'm charging within the market, but I know that I have one of the best properties in the market. So look around. Are people having upgraded bathrooms? If so, what's in their bathrooms? Do people have upgraded kitchens? If so, what's in their kitchens? Do they have stainless steel appliances? I love putting stainless steel appliances in my units because most tenants, when they come from other properties, they have those ugly, old, dirty appliances. But people love stainless steel appliances, and it doesn't have to cost you that much more to get a nice stainless steel appliance in your unit. Tenants love it, they're willing to stay longer, and many times you'll be able to charge a little bit more. If you can charge an extra $25 a month for your upgraded appliances, well, you might make your money back in 3 or 4 years. Kitchens, bathrooms, floorings, and ceilings can help you deliver a lot more value in your property, but you want to make sure it's in line with what's happening in your area. So if you don't want to be the person that's walking through the different properties for lease in your area to see what's possible, then get a good property manager who's going to be doing this for you, that can create a proposal about what needs to be done to increase the value of your properties. And then just naturally, when you upgrade a property, if it's a multi-unit property and you're making more money, it's going to be worth more money. And if it's not a multi-unit property and you upgrade a property, well, now your property is also going to be worth more money because you upgraded the property. And if you want to be a successful real estate investor, there are 5 areas that you have to master, that you have to understand if you want to be able to make real money in real estate. This is, you have to understand how to find the right location. You heard people say location, location, location. Well, it's 100% true when it comes to finding good real estate deals. Second, you have to understand how to find a good property, because if you have a good location and you have a really crappy property, well, you can still lose a lot of money. So you want to know how to find a good property, and how do you know what's a good property or not? Third, you have to be able to understand the numbers. You need to be able to know how to run the numbers, how to find a good cash flowing property that's going to actually make you money and not be a money pit. Fourth, you have to understand the tax side, know how you can use the tax code to your advantage in this particular deal that you're doing. And fifth, you need to understand and master the management side, because if you don't know how to manage your deal, well, it's going to be a major headache. These are the 5 things that I'm going to be talking about in this video. So let me start by talking about number 1, understanding the location. When you're investing in real estate, you are making a long-term investment. So you're investing for the next decade or 2 or 3 decades. You're not just investing for the next 6 months or the next 12 months. So when you're investing in real estate, you have to make sure that you pick a good location, because you can change everything about a property. You can change the way it looks, you can upgrade the bathroom, you can finish the basement, but the one thing that you cannot change is the location of your property. So you want to make sure that you're investing where people want to be in the future, not just where they want to be today. Because if you invest your money into a dying city where people are moving out of, where nobody wants to be, well, not only are your property values going to drop, but you're going to have a very tough time renting this property out, keeping it rented, and making any money on this property. And that's going to be a big pain, not just in your brain, but also in your bank account. So this is where you have to know, how do you find a good location for a property? And there's a few different things that you can do. The first thing that you can do is just go onto Google and enter in the city or the neighborhood that you want to invest in, and just type in the word population. And what you'll see is you'll get a chart of what the population is and has been for this particular neighborhood or this particular city. And you want to see some sort of upward trend, or at the very least a stable trend for this city or neighborhood, because if you're seeing populations go down, that's probably not a place where you want to be investing your money for the long term. The second thing that you can do to dissect the location is go to the city hall of the area that you want to invest and ask the building department what new developments are in the works or potentially could be coming in the future. This is a little known secret of a way that you can get real insider information of what's happening before it even becomes public. And this is actually legal in real estate, but it's illegal in the stock market, because if you learn something in the stock market before it hits the public markets, well, now you're doing insider trading and you can go to jail. In real estate, well, it's completely legal. And this is where now you can get a lot of value by just talking to the city, talking to the people that work there, talking to the people that live there, to see what's happening or what might be coming in the future before it even hits the mainstream news. This is something that I have done on multiple occasions. I found out, I was looking at an apartment complex in a city, and I went to the city hall and I asked them about this vacant building that was sitting on this very busy intersection, and I asked them if anybody had plans of purchasing this building or anything going on with this building. And what he told told me was that Walmart was in contract to actually open up a franchise or a store over here in that building. Now, this wasn't public information, or at least I hadn't heard about it until I went to the city hall, but this was great news for me because now I knew Walmart was going to bring a lot of money into this particular area, because if Walmart comes here, then you're going to see a bunch of other smaller retail stores also pop up, because now Walmart's going to bring a whole bunch of traffic to this particular area. People are going to want to be here because you're going to see more shops open up, you'll see more restaurants open up, because this is going to drive up demand for this particular area. So what you want to see is, are businesses moving into this city? Are businesses moving into this neighborhood, or are they moving out? If they're moving out, then you might not want to be moving your money in. But if businesses are moving their money in, then this is something that you can consider moving your money into as well. You also really want to pay attention to barriers and boundaries, because what you'll see happen is many cities will have some sort of boundary or barrier that will divide a good part and a bad part of a city. Sometimes it'll be a highway, sometimes it'll be a bridge, maybe it's a lake, maybe it's something, a railroad track in the middle that divides a good part of a city from a bad part of a city. And this can make a huge difference, because you might see a city as a whole, and the city will be growing and people like the city. However, what you might not see from that data is that people are moving from this part of the city to this part of the city. And so if you find a property on this part of the city on sale, you might think it's a great deal because it's in a growing area and a place that everybody wants to be. But what you don't see from that data is that everybody wants to be on this side of the highway. I saw this happen on a property that I bought. It was a single family home where there was a highway running right through the city, and all the businesses were moving here. You literally had businesses moving from this side of the highway to this side of the highway, and everybody wanted to live on this side of the highway, and the properties on this side were selling for significantly cheaper on this side. Well, I bought a property here because I wanted to be on this side, even though it was more expensive than here, and over the years, it really paid off. The property values here went up significantly faster than the property values here, along with the rental prices and the ease of finding a good tenant, because everybody wanted to be on this side, not this side. This brings me to number 2, understanding the property. And one of the best sayings that I heard about this is, find the worst property in the best location. Because you can't change the location, but you can improve the property. So if you have a good location, it's worth paying a premium to be in a good location, even if the property isn't as good, because then you can upgrade the property, make the property better, but you can't change the location. You can't buy a property here and move it here unless it's a mobile home, but you can't move a property across state lines or across a highway line, but you can improve the property itself. Now, this is where you have to understand what kind of property it is that you want to invest in, because you can invest in single family homes, you can invest in duplexes, triplexes, quadplexes, you can invest in apartment complexes, you can invest in commercial buildings, office buildings, you can invest in retail plazas, you can invest in medical centers. There's a bunch of different types of real estate that you can do, and this is where you have to understand what's important for you and what do you like and what do you want to specialize in. I personally prefer residential. I like apartment complexes, I like single family homes. I did invest in one mixed use building which had some commercial and some residential, but I only did one of those deals. But I like residential because for me, that is the easiest thing for me to understand, because everybody is always going to need a roof over their head. So I can easily understand the demand side of a residential building versus something like an office. Well, that's a little bit more difficult, because as we can see around us, the office environment changes with the economy, and the demand for office is going to change with that. And so the requirements of an office are very different than the requirements of a residential property. And then same with retail. Retail always changes. I mean, the world is moving digital. Some stores thrive in brick and mortar businesses. Some stores don't do well in brick and mortar. So I don't really understand that space as well as I do the residential side. That's why I focus on the residential side. Now, you can find what you like and what you're familiar with and invest in that, but the whole idea here is you want to be investing your money into a property in a good location. Now, once you figure out what type of property you want to invest in, the next thing you have to decide is how turnkey you want this property to be. Some investment deals are going to be completely turnkey in that it's a property that's already rented out and you don't have to do anything except just buy the property, and now now it's already producing cash flow. So there's nothing you got to do. The other side is you're going to find distressed properties where not only does this building or house or whatever not have a tenant, it's not even fully functional. Like it's got ugly carpets, it needs to be renovated, it smells nasty, so you have to put in physical work. Now you have to figure out where you want to be, but the advantage is if you buy this more distressed property, you're going to get a bigger discount than if you buy a fully turnkey property, because if you buy a property that's turnkey, you're paying a premium. Because now the person who owned it before, the investor, the developer, they put in the time and effort to make sure the property is beautiful, to make sure that it's all set up, to make sure that the tenants are already there and paying. And now what you're doing is you're paying for this completely passive deal where all you got to do is now get the cash flow, get somebody to pay the money into your bank account instead of theirs. So you're just buying a stream of cash here, which is much more passive than finding a deal that's much more distressed. So this distressed deal is going to come at a bigger discount. You can negotiate a better price, but it's going to come with more work, because not only are you going to have to renovate the property, but then you're going to have to get it filled up with good paying tenants, which takes time and it needs a good team. Most of the deals that I have done to date have been on the distressed side, where either it's an apartment complex or a home that has been completely run down. Maybe it's been into foreclosure, where now this property needs work. And now I can purchase this property at a discounted price, meaning below market value. Then I have a team now of contractors. It took me a long time to build a good team of contractors, but I have a good team of contractors that's reliable, that does good work, that does it at a decent price, and then they will come in, do the work, turn the property around, make it look significantly better, and now I can rent it out and make a bigger profit because I've been able to come in and buy the property at a lower price. But it takes more work. And it takes a time, because I had to go through really bad contractors. I had to go through a lot of headache with contractors, and I had to go through all that really effort, learning, and time in order to get to the team that I have today. But you have to decide, if that's something that you want to do, because not everybody's going to be wanting to work with these types of distressed deals, and not everybody has the cash to go out and pay a premium for the turnkey deals. Like when I was getting started in real estate, I had no way of affording these turnkey deals. The only things that I could do was buying the properties out of foreclosure. The one thing that I want to emphasize here when it comes to finding a good property is you don't necessarily want to go out and find the cutest and the best looking property. You want to find the property that's going to pay you the best return on your money, because you're buying this property as an investment, not as a place for you to live in yourself. Now, you want to provide a nice home for the tenants that are living there. You don't want to be a slumlord, because you're going to get burned in many different ways. But you don't want to buy this property with the intention of you living there. So you have to change that standard, but you have to understand that, hey, a good deal is something that's going to provide good cash flow, and then if you can improve the property in the best way possible, that way your tenants want to stay there, that way they want to pay you a premium, well, that's great. But you have to remember that you're buying this property to rent out, not to live there yourself, because now you got to look at number 3, the numbers. Every investment property that you buy is going to have these 5 expenses. You're going to have to pay for your property taxes, you're going to have to pay for your property insurance, you're going to have to pay for your property maintenance, you're going to have to pay for your property management, and then you're going to have to pay for vacancy costs if there are any. Now, this isn't money that's coming out of your property per se, but this is money that you're not making. So when you're factoring the numbers, when you're doing the deals, you have to make sure that you look at all of these costs to make sure that the property is still going to be profitable for you. So when it comes to taxes, I'll kind of work down this list. When it comes to taxes, what you have to remember here is that the seller's taxes that they're paying today is not necessarily going to be the taxes that you pay after you purchase the property. Because after you buy the property, the taxes are going to be reassessed. The property value is going to be reassessed. And if the seller purchased the property at a much cheaper price than what you're buying, well, then chances are their taxes are going to go up, because now the city can say, all right, this property is now 2x more than what the seller paid for it, so now we're going to increase your taxes. This doesn't necessarily mean that your taxes are going to double, because the chances are that the city was increasing the taxes for the seller every year, but there's a limit to how much a city can increase taxes every year. However, once the property gets sold, there's no limit to how high property taxes can go. So before you buy a property, just talk to the city. Ask the assessor how much the property taxes are probably going to be, and they can give you a good rough estimate of what your property taxes will look like. Second, when it comes to insurance, this is something that you do not do not want to miss out on. You have to have insurance, and the insurance here is going to do two things. One is going to insure the property, and second is going to insure you. So you want to insure the property because in case something happens to the property, it gets burned down or something really bad happens to the property, that you have insurance to cover the cost of the building. The second side is your liability, because if your tenant slips and falls on the property and they decide to sue you, you want to make sure that you have insurance to protect you from this lawsuit. And the reality, especially if you're in America, is that anybody can sue anyone for anything. I can tell you this from personal experience because my real estate company was sued because one of my tenants sued my real estate company because they claimed that the bathtub was too slippery when the water was on, and this caused the tenant to slip in the bathtub. It was completely a frivolous lawsuit. The tenant worked with one of those free attorneys who was just trying to get a settlement from my insurance because they know that we have insurance. But the reality is, if I did not have insurance, well, then I would have to go out and hire an attorney and pay somebody out of my pocket to try to dispute this, and it would have been so much more expensive out of my pocket. But because I had insurance, it didn't really come out of my pocket. It came out of my insurance's money because I pay money into my insurance every single month. And so while my insurance company had to settle to make them go away, which is pretty crazy, it didn't come out of my pocket. So you want to make sure you have insurance because you never know who's going to sue you for what. That's just the reality of this country. Third, you have to factor in maintenance. Even if you think this property is up and running, is perfect, is brand new, always factor in some sort of maintenance fee every single month per unit. And even if you don't use this money, well, now your real profits are just going to be higher than your projected profits, which I'm okay with. So always factor in some sort of maintenance when you're running the numbers. So you might see, okay, this unit, this house is making $1,500 a month. And you might factor in $100 a month or $150 a month for maintenance. But if you don't use that, well, that's an extra $150 in your pocket. But if you don't factor in the maintenance when you're looking at the revenue minus your expenses, and you're already running this deal super tight, and then you find out that you have maintenance expenses, well, now you're in the red, you're running a negative, you're running a loss because you didn't factor in the maintenance to begin with. So always factor in some sort of maintenance cost. Fourth, factor in a management fee. I don't recommend that you manage a property yourself. I always recommend that you hire a professional property manager whose sole job is to manage the property. Make sure the property is leased out. Make sure the tenant pays to document everything that's going on with the tenant, to fix the repairs, to get everything done with the property. But if you really insist on managing the property yourself, I would still recommend factoring in this management fee. That way you know what the cost is for the management. You're just paying this to yourself. But now, at least when you're factoring together the deal, you understand how much this would be, because now if you try to sell this as an investment unit, if you try to sell your property as an investment deal, the new investor is going to factor in a management fee, even if they don't want to manage it themselves. They're going to factor that into their pro forma, meaning their spreadsheet. And so if there's no management fee for when you buy it, you might be overpaying for something that you can't sell for the same price. So make sure you factor in a management fee when you're looking to buy a property. That way you know that it's going to be profitable for you. And the last one here is a vacancy cost, because the reality is sometimes tenants are going to leave. And when a tenant leaves, there's going to be time before the new tenant moves in. So you want to factor in a vacancy cost. And you can even apply a very simple 1 month a year vacancy cost. That way now, once you factor in all these expenses, you can see what the property would look like. Now, if nobody leaves, if you have very little maintenance, if your property taxes aren't as high, no big deal. You just have more money in your pocket. But at least you took that conservative financial statement and you knew what the expenses would be, and you factored in the other potential costs, because the last thing that you want is for you to anticipate making a profit, but then you're losing money every single year. And then you also want to factor in your mortgage. If you're going to not purchase a property cash, if you're going to have debt on the property, you want to also make sure you factor in the mortgage. And then you want to make sure that now, after you factor in all these costs, that it's still profitable for you. My goal when I invest in real estate is to make a minimum 7% cash on cash return on my money. Meaning, if I go out and I invest, say, $100,000 of my own cash, I want to make sure that after paying all of these expenses, this property is putting $7,000 of profit into my pocket every single month from cash flow. Not from invisible appreciation of the property value, but from actual cash flow from the property. That's the type of return that I'm looking for Yes, these types of returns are possible here in the Midwest, which is where I'm located, but it's going to vary area to area. But these are the types of returns that I'm looking for. So what you want to do is you need to know what type of return is good for you, and then make sure now that you factor in all of your expenses and then see if the deal works for the numbers. The fourth thing that you have to understand is taxes. And I'm not talking about the property taxes here. I'm talking about the taxes that you pay on your income. And this is where having a very good tax advisor, a real estate tax advisor, is going to be so crucial. Now, when you're investing your money in real estate, you want to make sure that you have a really good real estate attorney representing you, because there's going to be a whole bunch of little issues that can come up with real estate. So you want to make sure you have a good attorney. You want to make sure you have a good contractor that can take care of your deals, that can help you out with that. You want to make sure that you have a really good real estate agent that you can work with that will find you real estate investment deals. So these are agents that are not working to help people buy and sell their dream homes. You want an agent that's going to help you find an investment property, but you also want to make sure that you have a really good tax advisor, an accountant that's going to help you who specializes in real estate, because real estate has a whole textbook full of special deductions, of special tax breaks that you can use as a real estate investor. And these can be things from special entities that you create, from ways that you purchase properties, from ways that you take depreciation, to ways that when you sell a property, how do you buy a new property? That way you can literally make money without paying any money in taxes today, because real estate has some of the biggest and best tax breaks that a tax code has to offer. Now, I am a licensed attorney, although I'm not your attorney, and I'm telling you this from experience because you need to have somebody professional who's guiding you. Now, one thing that I've learned is that there's a difference between a tax filer and a tax planner. Like, I've had a CPA in the past who would just file my taxes. They would look at my bank statement, my credit card statement, and all of that, and then they would file my taxes, but would give me almost no guidance as to what I can do to limit my tax liability. Now I have a tax advisor that cost me a lot more, but now I'm meeting with my tax advisor pretty often, and we're working to talk about how much is my tax liability and what are things that I can do based off of the current deductions, the current tax laws that are happening right now, because they change every year. What things can I do right now to limit my tax liability? And this will change the way that you do business. And so now when we talk about real estate, there's a lot of different things that you can do. So you want to have a tax advisor earlier on, because one of the things that they can do is they'll work with you when it comes to the actual purchase of the property, and you'll learn how much is the building worth, how much is the land worth, and then within the building, how much is the carpet worth? How much are the appliances worth? How much are the different things within the property worth? Because then they can depreciate the value of each one of these things differently on your taxes, and this will provide you different levels of tax breaks each year that you own the property. Because when you own real estate, one of the things that you can do is every year you will tell the IRS how much money you made in your profit. And then against that profit, you will also take another deduction called depreciation, which essentially says my real estate is 1 year older, so I deserve a tax break. Now, the amount of money that you can depreciate is going to depend on the value of the building and the value of everything else inside of the property. And so if you have a good tax advisor, you have a good accountant that can work with you to figure these things out earlier, you can start taking these tax breaks sooner. So when you start making money, you know that you're going to be paying the least amount of money in taxes as legally possible, because the IRS gives you a rule book. The rule book is the tax code. And this is where now, if the tax code says that you can take certain deductions and certain depreciations, you should take these things, but you need somebody who can help you do that. And fifth, you need to know how to manage the property. One of the people that you have to have on your team if you want to be a passive real estate investor is a really good property manager. And I'm saying that they have to be really good because I have worked with really bad property managers who didn't do much. Like the first investment deal that I bought, I had a horrible property manager who really didn't do anything. I found the tenant. The tenant had my cell phone number, and every day I was getting calls from my tenant about random things because this was a nightmare tenant. But I learned the value of having a good property manager. Now, not only is the property manager going to make your life easier because now they're the ones that are finding and dealing with the tenant to make sure everything is good, but the flip side of that is they're also supposed to document everything. So I talked about the lawsuit that I had to go through, where a tenant sued me because it slipped in the bathtub because it said that it was too slippery when the water was on. Well, we had done everything above and beyond for the tenant, because anytime the tenant filed any sort of complaint for the property, we sent contractors immediately to the property property and not only solved any issue that they would have had, but tried to do even more. Like one time they did say that in the bathtub, there was a little chip of paint. It was like a 1/4 inch by 1/4 inch, a little tiny chip of the paint. So they called up the property management company. My contractor went out there. Not only did he give an estimate to take care of the paint chip, but he also offered to put in a handicap pole for the tenants because he said that the tenants are a little bit older. So he said, we should put in a handicap pole. I said, that's fine. So we were going to do that, but the tenants kept refusing it. And they did that again and again and again. My contractor literally went to the door, knocked on it, and the tenants would say, we don't want you to work today because we're tired or for whatever reason. Now, we had all of these things documented in our notes because my property manager does that. I'm not super good at taking these notes. I'm not very well organized in that sense, and I have other things that I need to focus on, so I wouldn't do that myself. But my property manager did that. So now when they filed this lawsuit, all we had to do was show all the notes from the property management company and they had no claim. Now this is where a lot of people run into this debate of why would I want to pay a property manager, because now that means my profits are going to be smaller. And you're 100% right. Your property manager is going to cost money. However, in exchange for the fee that your property manager charges, you get your time back. So now this is where you have to value and understand, what do you want to be? Do you want to be a property manager or do you want to be a real estate investor? If you want to be an investor, your time and focus and energy should be spent trying to find more real estate deals instead of trying to just manage the deals that you have. And so for me, I want to be an investor. I don't want to worry about managing deals. I don't want to go through that headache. It's not worth my time and I'm not an expert in that. Instead, I can hire the experts who take a fee, and now I get my time back and I can spend my energy, time, and focus on building more real estate deals. So this is where you have to figure out where you want to be, and I would recommend that you focus on building that growth mindset where instead of just trying to pinch pennies of how much you can make out of this one deal, figure out how you can buy more deals, have a bigger pie, and the only way that you can do that is if you're not the one individually managing every single deal. I started investing in real estate back in 2012 when it was the bottom of the real estate market. Now, back then, I had no idea what real estate investing was. I didn't know any real estate investors, so this was a completely foreign subject for me. So I started investing in real estate kind of on accident, and over the years, I built up a portfolio of single-family homes, multifamily units, and even a mixed-use building, and I did this through 2021. I've been changing the way that I invest my money on my personal side and my business side, and I made a video talking about why I will not be actively buying stocks in 2022. But this video, I wanted to talk more specifically about real estate and why I don't plan on actively buying any real estate investment properties this year. The first thing that I want to make absolutely clear when it comes to investing your money, whether it's real estate or stocks or really anything, is when you buy low, you have a better opportunity to make more money because you're able to buy an asset when it's on sale. So if you can buy stocks or buy real estate when it's on sale, you have the opportunity to see even bigger returns. The difficult part about investing your money when things are down is that everybody is running around with their heads cut off saying that the world is going to end and that you're not going to make any money and that everything is going down to zero. We saw this happen back in the 2008 crash when it came to real estate. When I first started investing in real estate, everybody told me that this was a horrible thing to do because so many people over the last number of years had lost their shirts, have gone into foreclosure, had gone into bankruptcy because the real estate market was this evil, bad thing. But for me, I saw it as opportunity. And so if you are able to find assets when they're cheaper, well, that gives you the opportunity to buy assets at a discounted price, but you have to be mentally ready to buy the assets that are strong at a discounted price because majority of people are not going to see it as a discount. Right now in 2022, it's become significantly more difficult to find good real estate investment opportunities. I mean, home prices have gone up significantly across the country, and now with mortgage rates going up, housing costs are going up a lot. So it's become harder and harder to find good real estate deals. Now, there are still some out there, but it's become significantly more difficult to find them. Like last year in 2021, when I was looking for investment properties, I had to make offer after offer after offer after offer before I got any that were even accepted. And these were offers that I were making above asking price. I had never really had to do that before. Typically, when I'm looking for deals, I'm looking for beat up properties. So I'm not really making offers above asking price, at least not over the last decade. I would make offers below asking price and the sellers would work with me because they wanted to sell their homes. Nowadays, it's much more difficult to find that because we're still in a strong seller's market where there's a low inventory of homes and there's a lot of people that want to buy homes even though home prices have gone up so significantly. But the real reasons for me not going out looking for more real estate investment properties right now goes beyond what's just happening in the economy. And for you to really understand this, I'm going to pull back the curtains a little bit and show you a little bit more about how my personal finances work and how I manage my money, particularly when it comes to my business money and my personal money. I'm not saying any of this to brag. This is just to give you a better understanding of really how I manage my money. So I make my money from my businesses. So I have Minority Mindset and Market Briefs. Minority Mindset is this YouTube channel, which is my personal brand, and then I also have a blog, theminoritymindset.com. Market Briefs is our financial newsletter. It's a financial newsletter that I created where every day we send out a financial breakdown of what's happening in the finance and business world. You've probably heard me talk about it many times on this channel, but this is a free newsletter that I created that breaks down everything that's going on in the news in a fun and witty and educational way. So these are my two businesses that I own. Now, through Minority Mindset, what I do with my money is I take the revenue that I generate. Let's say I generate $1 million directly from me. This would be advertisements from YouTube and from sponsorships. So if I can generate $1 million, I don't take $1 million and go out and start living life. Now, this is typically how a lot of people operate, where you make $1 million and you're gonna go out and spend $1 million. But that's not what I do. So if I generate $1 million, this goes into the Minority Mindset bank account. Now again, this is money that I generated. This is that money generated by other things that we have in the business that our team does, like our blog. So if I generate $1 million, the first thing that I do is I will pay myself a salary of 20% of what I earn. So if I generate $1 million, I'll pay myself a salary of $200,000. Then that leaves $800,000 in the bank for business purposes. Now, out of this $200,000 salary that I pay myself, most, if not all of this money is being passively invested. So this money is passively being invested into stocks. This money is being passively invested into physical gold. This money is passively being invested into some cryptocurrencies like Bitcoin. This happens whether the market's up or down, and the vast majority of my salary, if not all of my salary, is being used to be passively invested. Then I have this profit. So for the past number of years, a portion of this profit was reinvested back into Minority Mindset. Some of it was invested back into Market Briefs. Some of it was invested into Market Insiders, which is the app that I created, the investing education app. And some of it was invested just into anything else related to the company. Then with whatever's left, I would then take that money to my personal finances. So I'm gonna put this as me, draw me a nice turban, smile. So whatever's left, let's assume for this case, it's $200,000. I'll put this money into my personal finances, and then this is the money that I would use to go out and actively buy real estate and actively buy stocks. So now I'm looking for undervalued investments, maybe startups. So I'm gonna go out and invest this money in whatever way I can. Now you might be thinking, well, Jaspreet, if you're investing this money and you're investing this money, what money do you eat with? Well, I also have my personal investments, so my real estate. That's the money that I try to live off of. So I have my cash flow from my real estate. Most of that is what I use to live off of. And then if there's some more that I need, then I'll typically live off of that. But my profits is what I'm typically looking to invest. So this is how my finances have been run. And depending on whatever the numbers are, it kind of just scales the exact same way. If I make more money, again, just that 20% number, and it goes through this funnel. But now, after a lot of soul searching that I went through in the early part of 2022 and the later part of 2021, I talked about this before, but I went on this thinking trip to Boca Raton, Florida, and I think I want to do this again this year because this thinking trip at the end of 2021 really changed the way that I did a lot of things. Because what I did was I lived in this small little apartment alone. I had a bicycle, I didn't have a car, I limited myself from technology, and all I did was in the mornings, I rode my bike to the beach. And I would write down my thoughts in my notebook. And these would be thoughts about anything. It would be about happiness. What is happiness? What's important to me? What do I like? What do I not like? What do I enjoy? What do I want to do more of? What do I want to do in my business? So I was just writing down my thoughts. And then as I got to my business, I would start questioning, what do I want to do? What am I passionate about? What is Minority Mindset? Because back then, in the later part of 2021, there was no Market Briefs as a separate entity. Everything was under the Minority Mindset brand. And it was then that I wrote down minority mindset question mark, because I started to question, what is minority mindset? What is market briefs? What is my company? What is me? Right? I'm an entrepreneur, and so I was starting to understand and kind of think that this minority mindset brand that I was building was a company, but it wasn't. Minority mindset is me. And that's when I decided that I wanted to separate my companies like Market Insiders and Market Briefs and make that separate from minority mindset. So now we went on this journey of separating minority mindset, separating Market Briefs, and building Market Briefs as its own company. And it took a number of months to get things situated, from the legal side to the technical side to the actual brand side, because we had to change a whole bunch of things. And it wasn't really until April, if not early May of 2022, until everything was fully situated and things were running completely smoothly on Market Briefs. And now we have all the systems finally organized, where we have the business development process, we have the creative process, and we have all the things running, where now the goal is really to turn Market Briefs into a larger newsletter, into a larger company that can serve more people, that can really help provide the value that I want to help provide to the world. So now my question is, what do I do with my personal finances? Well, instead of me just taking out this profit and putting it back into my pocket, what I'm thinking now and what I'm going to be doing is taking whatever's left here and investing this more aggressively into the Market Briefs brand. That way we can grow Market Briefs into really a dominant force, bigger and quicker. Because this is something more on the purpose side that's very important to me. I didn't grow up learning about financial education. I didn't grow up learning about money. I didn't grow up learning about news. And now we're entering a very turbulent time in the economy. I mean, you can see everything going on in the stock market and the real estate market and everything going on in the economy. We're entering a very turbulent time. And, anytime you go through these type of turbulent times, a lot of people get hurt financially. And the people that get hurt financially are the people that don't understand what's going on. Like when the 2008 crash happened, you saw so many people cash out of their 401ks, even though they were 30, 35 years old, because you're worried about the market crash. And now you lose 50, 60, 70% of the value of your portfolio. And then you see the portfolio grow back up and you don't get any of those gains. You lost a lot of money. And we've seen this happen again and again and again. And so I want to help spread this financial education. That's very important to me. That's why I make these videos. I started Minority Mindset with no intention of making money. It was really a hobby for me because I was working on other businesses, I was working on the other investments, and I wasn't making any money with Minority Mindset. So it was just something that I did for fun. And slowly, Minority Mindset started to grow. It became bigger. It started to generate some money. And then I decided to spend more of my time in Minority Mindset. And then I decided to spend all my time in Minority Mindset. And then that's when I started to develop Minority Mindset into a company. But that's when I realized that Minority Mindset is not going to be a company, it's going to be me, and I'm going to work to help grow my companies, because I can build Market Briefs into something that's bigger than me. Minority Mindset is me. At the end of the day, the only people that I can reach are the people that watch my videos and the people that want to watch me. But Market Briefs can grow bigger than me. We can scale it to something that's more than me. And this will allow me to help serve my purpose, to help spread this financial education, to help make financial news more accessible. Because if you go and turn on CNBC and you have no idea how money works, you're going to be very intimidated. If you go and read Forbes, if you go and read Wall Street Journal, it's going to be very scary, very intimidating. And if you're really trying to keep up with what's happening, you're going to be very overwhelmed. You're going to spend hours trying to figure it out. And that's where Market Briefs comes in, because now in just a few minutes every morning, our team will break down exactly what's happening, things that you need to know in a fun, easy, and witty way. And you're going to actually look forward to reading this email, because we're building a whole community, not just an email. And this is something that not only am I really passionate about, but for me, it's a lot of fun, because I can see the impact that we're having. Because when you subscribe to the newsletter, you're going to see all the value that we get. And then people respond to the newsletter talking about how it has given them so much value, how they can't believe that it's free, how they love everything that they're getting from the newsletter. So I can see the impact that we're having, and I want to help scale this impact quicker and faster. Now, one of the ways that we can do that is me investing more of my time into it. But the second way is me investing more of my money into Market Briefs, which is risky, right? Because there's a chance that Market Briefs will fail. It's a startup. A lot of startups fail. But my goal now is to invest my money and my time to help grow Market Briefs into something a whole lot bigger than just me. And the easiest way for me to do that is for me to take these profits, no longer put them into my personal bank account so I don't go out and invest this money or go out and buy nice cars or things or whatever with it. I'm not a super materialistic person. I don't really care about brand names. I don't care about wearing designer stuff. For me, it's more of a game. I like understanding money. I like understanding finances. This is something that I enjoy. And if I had nothing else to do, this is the same thing that I'd be doing because I like learning about money and I like teaching about money because this is something that we should all learn when we go through school, and Market Briefs allows me to do that. Now, I do want to clarify one point because when I made that video about why I'm not actively investing in stocks anymore, I got a lot of comments from people saying, why would you not want to invest in stocks right now when the market is falling? And I want to clarify this because you're right. When things are lower, that is a great opportunity for you to come in and buy. The reason why I'm not investing actively in stocks and the reason why I'm not actively investing in real estate isn't because of what's happening in the economy. I mean, remember, buy low, sell high. That's what you want to be doing. It's for me, it's a bigger purpose for me right now, and I have a bigger financial opportunity. I'm not gonna lie, like my goal is to make money with Market Briefs. I'm not taking out a salary from Market Briefs right now. I'm investing my money into Market Briefs. But for me, it's to grow Market Briefs into a much bigger company. Now that comes with risk, right? I'm investing more of my money. I haven't seen a return. I haven't gotten a penny out of Market Briefs yet because I'm reinvesting the profits and I'm gonna keep doing that. But for me, it's to build it into something a whole lot bigger that we can build a company that's a whole lot more scalable. If I wasn't an entrepreneur and if I didn't have a company right now, then yes, I would continue to buy real estate even today. I would continue to buy stocks even today. Even though stock market prices are lower, I would continue to be buying, looking for opportunities there. Even though real estate prices are higher, I will continue to be looking for the prices because for me, it's not about trying to time the market. It's about trying to find good opportunities in the market, right? This passive investing never stops for me. This is something that I do whether the market's up or down. But this active investing is something where I'm just looking for opportunities. Sometimes you gotta dig a little bit deeper. But now for me, my active investment is gonna be my business. I know this video is pretty different than the other videos that I put out on our channel. And again, my goal with this isn't to really brag and say, oh, look, I got this business, or look at how much money I'm making. That's not what I'm trying to do with this. I'm really just trying to provide some transparency into what I'm doing with my money right now, how I'm investing my money, because I want to be fully transparent because, well, we are a financial and business channel and an investing channel. So I want you to understand how I'm investing my money. That way you can understand what it is that I'm doing. So I hope this video helps shed some light on that and helps clarify some of those questions that you might have had. We talk about building a business that's scalable. I've talked about that many times, where you want to build something that can grow, that doesn't necessarily need you. That's the definition of scalability, that it can grow and it doesn't necessarily need you to grow. But if you want that business to be able to grow and not need you to grow, you have to do things that can't grow. The